to this lesson where we're going to talk about risk management according to the trade ideas and how you can protect your capital. So what we're going to do is you're going to go through a couple of examples of how you can be able to manage your risk, and I'm going to show you examples of how different risk parameters have performed in the past, so you can go ahead and sort of get an idea of exactly how that works. So let's go ahead and get started, and I'm going to show you ways to manage your risk. And these are the 3 ways to manage your risk. These are the guidelines that we're going to provide you, but we're also going to go ahead and say that, nothing is set in stone. Of course, everyone comes in with different trading accounts and how you want to manage it and what type of risk tolerance you are able to apply to your trading account and that you're willing to apply to your trading account. So keep in mind, these are guidelines. This is not set in stone. Everything is going to be based on what you want to do. You are in control of your account. You make the decisions how you want your account being traded. But keep it in mind, with that comes responsibility, and you are going to be responsible for it ultimately at the end of the day. So let's take a look and see. The first option here is we have the trade setup based on risk, aggressive risk. And aggressive risk is set up with 1 microlot per 1,000. Now, I'm going to say this, with the aggressive risk parameters, with $1,000 for every microlot, so which means that if you've got and let's go ahead and do this, if you've got a $3,000 trading account, then you would be trading with 0.03 lots. So it's $1,000 you're going to be trading with every 1 microlot, or let's put it this way, 1 microlot for every $1,000 in your trading account. Okay? Now, if we're going to look at the risk parameters as an aggressive risk, then I'll need to make sure that everyone understands that when applying a very aggressive risk appetite, then you would need to have additional funds available. How much funds would you need available? I would say that if you are trading with an aggressive, it's always safe to have at least twice as much, which means if you're trading $1,000 trading account, have available $2,000 to add to the trading account. Now you might say, well, Big Dog, I don't have that. I don't have additional $2,000. Don't worry. We'll be looking at ways to manage your risk if you don't have additional capital. All right. So if you only got $1,000 and you don't have additional capital, which means you cannot opt for the other options here. How do you manage your risk if you don't have additional capital? We'll talk about that in the latter part of the videos, okay? But for those that do have additional capital, but do want to get the maximum out of their trading, and they want to go ahead and trade with the aggressive approach, then make sure that you have funds available. Now, the reason why I'm saying start off with $1,000 and have the additional funds available on a separate account that you can fund it at a later stage is because when you trade aggressively, you don't want to expose all of your capital in one trading account. If something really goes wrong and you blow up that trading account, at least you're not blowing up your whole portfolio, that you're only blowing up some of your portfolio. Okay? Now, another way to look at this as well is saying, if I'm going to trade aggressively and I do have additional funds to go ahead and fund it, then that means that you'd have to keep an eye on your margin levels. Now, you'll have to find out from your broker, when do they start margin call? All right, when do they start closing out your positions when you start running out of margin? Now, it's your free margin that you start running out of, and that's where they start looking to close out your positions. Find out the rules. Every broker has different rules. Find out the rules that your broker has when it comes to margin call. All right, when it comes to what they call, I believe there's a new word now called close stop. So when they do a close stop, which means they close out your positions, and normally they'll take out the biggest position first, close that out, and start reducing your positions accordingly until you have enough free margin. Now, with that being said, find out from your broker so that you know what you have to look for. All right. So when your broker says, hey, they start closing out positions at 80% of your margin levels, then at least you know that when you get close to 100%, you must make sure that you pay attention to your margin levels. And if you need to add funds, then go ahead and add it. Now, if you go ahead and use the $3,000 moderate risk right here, this is 1 microlot for every $3,000 in your trading account, there is less likelihood that you would need additional funds, especially for a trader that has got a broker that has got higher leverage limits, which means that here in the US we are trading with a 50-to-1 leverage. But in international brokers out in Europe, you can go as far as 500-to-1. In fact, I've seen even 1,200-to-1. So depend, of course, on your broker leveraging, all right, you might not need additional funds at all at a one microlot per $3,000, all right? And I found it even with a US broker at a 50-to-1, the chances of needing additional funds on the strategy we use when applying the one microlot for every 3,000 becomes less likely that you'd need additional funds. So keep that in mind. The moderate is probably the better option if you can go ahead and manage your risk accordingly. Again, I'll show you how the results come through and what type of results you can get with that type of risk. And then if you want to be really conservative with your funds, then of course this option right here, 1 microlot for every $5,000 is the conservative risk parameters. At this level right here, you probably would never have an issue with margin. All right. Now, I don't want to ever use I really don't want to use the words never, because of we could always have some flash crashes. There could also be something big in the market that could happen. So, but there's a very low likelihood, unless of course something huge fundamentally happens in the market, that you would ever need to have additional funds. So this is the 3 sort of levels. And again, I want to make sure that you understand that doesn't mean because you don't have, let's say, $3,000, but you have $2,000, that you can't go ahead and manage your risk with $2,000 and say 1 microlot for every $2,000. That would also be a area where traders could go ahead and say, well, I'm going to go ahead and risk 1 microlot for every $2,000, and that is also within the guidelines. So again, nothing set in stone. This is just a guideline to give you sort of an idea of how to be able to manage your risk and what it means for a trader when he manages risk with $1,000 for every microlot. What does that mean? Well, there are conditions, and the condition is you have to, and you would absolutely need to have additional funds. And if you don't have additional funds, I'm going to talk about another option later in the videos, okay? Now, let's go ahead and move on right here, because I want to go ahead and take a look at results. Because I think it's important that you know then when you risk in a certain amount of risk, that there are also drawdowns, right? And so with the 1 microlot per every 1,000, you'll notice here that our drawdowns we've had, and I've said this before, that we would have at least about twice a year, we'd have drawdowns that would go ahead and test your margin levels. And you can see right here, we had drawdowns in 2022. And by the way, I'm using 2022 as the benchmark, because the results we're going to look at is in 2022. So I'm also just going to take a look at and focusing in more on the 2022 drawdowns. And you can see right here we had drawdowns around about 30%. And then we had drawdowns over here at 40%. And that is, of course, using an aggressive risk parameter. All right, 1 microlot for every 1,000. So if you look at the and this is what's very important. 14 times the market had tested the 10% level. So you can see that we were actually hovering below 10%, okay, quite frequently, all right? And then we did go to 20% 3 times, we go to 30% 4 times, and we went to the 1%, we went to 40% one times in the 2020. Now I believe this is different. I think we actually hit maybe 30% this year. 1, 2, 3, 4. Oh yeah, we actually hit 4 times. Not 3 times. 4 times 20%. 1, 2, 3, 4. Yeah, but you can see you can follow 4 times. I see this as 1, but yeah, you can say 4 times right here. Now, Why am I showing you this? Well, I want to show you that traders, what you have to get used to is drawdowns. All right, with the strategy that we use a cost averaging strategy, we're going to see some drawdowns. All right, because we buy and sell at resistance and support, and if that support and resistance breaks, we get into drawdowns, and we're trading it back towards that support and resistance. So drawdowns is always going to be a factor. We have to make sure that we understand this, so that when we go into our trading right from the get-go, we understand what we're getting ourselves into. And so that we understand that we can get to higher drawdowns as much as 40% using this parameter of 1 to 1,000. So 1 microlot for $1,000. Now, if we go ahead and take a look at the results in 2022 for that sort of risk parameters, you can see the risk has been high, but the profits have been high too. So we've seen some good profits with this type of risk parameters, but there has been that drawdown. So very importantly, understand we will get into drawdowns. The profit levels will be high, but at the same time, keep in mind that you need additional capital if we do get into those higher drawdowns. And if you don't, we will look at another option as to how you can manage that risk if you don't have additional capital. Here is a less risky approach, which is 1 microlot for every 2,000. We spoke about that. And you can see right here, the drawdowns also stayed pretty low right here. You can see we only reached the 10% level 4 times. Other than that, it's been low. It's been below the 10% mark. Yes, it has got a little higher, got to that 30% mark as well with this sort of risk. So which means that traders, you might need to have additional capital. They might need, all right, there's less chance of needing extra capital, but if you've got a $2,000 trading account trading with 1 microlot, then there is a chance that you may need to have additional funds, all right? A very low probability, but possibly. Now, if you look at the results have been pretty solid as well. So you're looking at results anywhere between, 8 to 10%. It's ranging more around the 9 or 8 to 9% return monthly. So that gives you sort of a guideline. If you want to go ahead and ever manage your risk accordingly, you can do that and say, you know what, with this type of returns, maybe I don't want to be so risky, or maybe this suits my risk tolerance. So this is what the results have been so far in the past in 2022 for the risk parameters of 1 microlot per 2,000. Let's go take a look at the 1 microlot per 3,000. You can see right here again, look how low the risk has been right here. In fact, it looks like it's down there at about 5 or 6%. It's kept it right there. We've had a couple of deeper drawdowns right here, which spiked up a little yet to that 30%. But in most cases, we should be good below that 10% level. Most of the year, we should be staying below that 10% level, which is pretty good. Okay. Now, what are the type of returns we get on that risk parameter? Well, 1 microlot per 3,000, you can see right here that we get in around about that 5%, 5 to 7% return. So again, that's a pretty solid return for a very low risk. And this is what's important right here. All right. If you're looking at most of the year below that 10%, which means around about 5 or 7% drawdowns, and we're seeing results of 5 to 7% in returns, then that means that your drawdown levels can be covered pretty quickly in 1 month's trading. So as long as we're making 5 or 7% per month and our drawdowns are 5 or 7 consistently throughout the year, then we're going to be gaining profits. Okay. Here's the conservative risk. Here we go, 1,000 or these 1 microlot for every 5,000 right here. You can see right here that we're very low. In fact, we've hardly gone over the 10%. It's kept at 7.5%. And you can see here that we've kept at 2.5% right here most of the time. Did get to the 5% a couple of times there. One time, actually once. And 7.5 once as well. So with that, we might be able to say we got to that 5% twice with that little spike there. But it's like most of the time it's down there below that 2.5%. So 2.5%. Here's the returns that we've got so far. I don't have too many accounts that are set up on a 1 microlot for every 5,000. But I did find one that I could have brought in the results. So here's the results here, and as you can see, we got 4%, 3%, 2%. So I would say that anywhere between 2 to 3% would be your sort of like targets that we could possibly get with that sort of risk tolerance. Now, very importantly, as you look at this information, as we go into the other lessons, we're going to be talking about how you can protect your capital by using the profits over the first 3 months and using that to protect your capital so that if you ever get into the high drawdowns, you can eventually cut your losses, restart, and go ahead and start your whole process all over again. So we'll get into that into the next videos. I'll see you in the next video.